All right, I'm here with Tom Arcieri with Authentic Advisors. Tom, thank you so much for joining me today. Tom was actually, some of you know that we had an insurance agency for years and years up in the Pacific Northwest. Tom and Authentic Advisors were actually our advisors group that facilitated the sale of our insurance agency. So a little bit of a personal connection for me here. And I appreciate you taking the time out of your day to join us.
It was a pleasure to join you. Thanks so much for having me.
Awesome. Yeah. So, the topic today is insurance agency owners and how they can best prepare for a successful acquisition. Our acquisition just kind of happened upon us, but, there's a lot of agency owners out there that this is their end game. This is where they want to, their exit strategy. Or maybe like for us, maybe it's their transitional strategy to pivot and do something else that they want to do. So what are some tips, that you can give agents that are out there selling insurance right now? How can they best prepare to have their agency acquired?
Right. So let me first start by saying that there are very few sort of exit transactions in our business. The nature of an insurance agency is really a people and a culture business. There's a lot of goodwill that's attached to all of the clientele, and then the owners of an agency, and then the employees through the owners. So that's really the values, this goodwill and the reputation. So, so long as someone is doing right by their clients and has a successful business, there really shouldn't be too much that one would need to do. You're really yourself, because at the end of the day, there's going to be a really partnership transaction. The new buyers, all these national buyers, they are very much dependent on those current owners and employees continuing to service and run that business. They might be able to cut out some things, on the accounting function, some IT, et cetera. But by and large, the value in all of these businesses is an ongoing cash flow stream. And that ongoing cash flow stream continues because the current ownership and employees know how to service clientele and know how to help them. So, it's difficult to really, tweak this and that, because at the end of the day, when you are going to sell a business, they're really going to go under the hood and look at, pretty much every single thing that you're doing.
What are the attributes of the agencies that you see? Because obviously you have a lot of, deals in the wheelhouse at any given time, right? And a certain percentage of those are going to close, and maybe a certain percentage of those are not going to close. So what would you say that percentage is? And then what would you say the attributes are of the agencies that successfully finish that transaction versus the ones who don't?
Sure. So I would say of 10 engagements that we take on where we sign a service agreement, I would say 9 of 10 will actually come to fruition and end up selling.
Yeah.
The 10% that don't, it could be because, the business is flattened, the business could be deteriorating, and they're not achieving a price that they're comfortable with. And our advice might be to them is, hey, you got some good things going. COVID, for some industries really was very tough. So sometimes it's just a question of waiting and trying to get a trajectory. Growth trajectory is very important. The buyers really want to see some type of organic growth because, everyone believes that what's, happened in the last 3 years should kind of continue going on to the next few years. So that really can drive multiples. So if anything, if someone has had, some nice growth, and good growth being like, call it 10 to 12% compounded, like that's, excellent organic growth. Obviously, the smaller you are, probably easier to have, higher growth. But those are typically, good elements that a buyer, will look for. And when they price a transaction and they see that type of growth, it really does drive the multiple.
Sure. So how many years of growth are they looking for typically? 3 years, 5 years?
I think 3 years is really, I mean, look, the longer you have compounded growth, the better. But it's really they're going to look at the last 2 or 3 years to see how the business is trending.
Sure. So what are multiples doing right now here in 2022? What are you seeing as the trend setter for the new year?
They continue to be at all-time highs. So there's a lot of new private equity money that has come in the last 3 to 5 years. And there's still, a lot of old private equity money that has been around for 10 to 15 years. So, look, typically at a million EBITDA level, the multiples, I'll say plus or minus 5%. They're really at, sort of 9.5. If there's some good growth, younger principals, they could get 10 up front. That might take a portion of that in someone's common stock, could be 10, 15, up to 20%. And then there's, pretty aggressive earnouts, either on a 3-year basis or on an annual basis to really incentivize that current team to keep on growing the business. So we're at all-time highs still.
Okay. And so, what are most of the deals you're saying that the owners stay on board?
Absolutely.
Okay.
Yeah.
So what percentage of your transactions would you say are owners staying on board versus not?
Um, I would say that it's even higher than, it's a good 95%. Like we're working on a deal right now. There's a couple of owners that, said, hey, I'll transition for 6 months or maybe a year. But if you have someone that can just take it over, and that's one of a dozen. Very, very rarely do we find an exiter. Actually, you know what? There's a second one that we're doing as well. So, look, I guess if there is a local firm that they have a relationship with, and and there's a transition time, then like to me, 6 months or a year, that really is an exiter, right? That's not someone that's staying on, for really the typical is probably 7 to 10 years is really what the buyers are hoping that the current management is going to continue to stay on for.
And what kind of incentives do a lot of the buyers put into place for, so like, let's say that I'm an agency owner and I'm looking to sell, and I'm on that 7 to 10 year plan of, staying on board with the new owners. What are generally speaking their responsibilities? Probably to keep running the business, but like what's expected of the owner? And then, I mean, how are those deals structured? Do they get cash up front? Do they, get cash at the end of the 7 to 10 years? I mean, what does that look like generally?
Sure. So everyone takes an ongoing salary from the business, and it's a fair market value salary. A current owner, if they want a little bit more in salary, then that would get deducted from their EBITDA. So they're not going to get that upfront multiple, so that's typically, let's call it a 9 multiple. So a fair market value pretty much across the country is, probably between 175 to 225,000. That's what it would cost if the owner of a, $2.5, $3 million agency got hit by a bus. They had to hire like a true pro to come in and run that business. They're gonna have to spend $200,000.
Okay.
Right. So they get their ongoing salary. They get their, let's call it the 9 times on this million of EBITDA. They got $9 million day one. They typically get about 15 to 20% in someone's stock. Some buyers will do zero stock, but most of them are really between 15 and 20. They want these sellers / new partners to have some skin in the game. And then typically what happens is if the business grows at certain compounded growth rates, then that owner for the first either 1, 2, or 3 years, the buyer keeps like the first 3% of the growth. Then anything above 3%, they really give back to the owner. It's not at that same 9 multiple. It's typically somewhere around a 6 multiple. By way of example, Abe, if someone grew from a million to a million one, 10% growth, that first 3%, so 30 grand would go to the buyer, but then that additional 70 grand would get multiplied by 6. So after year one, not only do you get your $200,000 salary for running the business, you also get another earnout payment of about $420,000, which is also coming to you at long-term capital gains. So there are very aggressive incentive plans to keep these owners engaged. After the earnout period, you usually get paid sort of as a producer. You still have your salary, but if you're bringing in new business, they sort of set new goalposts for years 4, 5, and 6, and 7, 8, and 9, and you're typically getting your whatever your splits are, 35 or 40 on new, 25 or 30 on renewals.
Okay.
So they're always asking you to grow.
So then you'd get the cash up front, you'd get the incentive payout for the year after the sale of the business, and then you'd be, basically a producer with an executive salary after that.
That's exactly right.
Okay.
Yeah.
Now tell me about the person that's looking to exit that just takes all the cash, essentially up front, with maybe an earnout period at the end. How are those deals looking right now?
Again, it really depends on the nature of the business, depends where the business is, what are the probabilities of everyone, getting through a renewal period.
Yeah.
But by and large, there's probably not going to be an earnout because the owner's gone. There could be a key lieutenant that is, might be the new leadership that's been, with the owner for 10 years, and maybe they could incentivize that person. But by and large, I would say an exiter is probably going to get, between 15 and 20% less than someone who's going to keep engaged in the business and try to grow it. Sure.
So tell me about Authentic Advisors. How did you guys start? What deals do you specialize in? And who, I don't know if you'd name names or not, but the profile of the buyer that you guys work with.
Sure. So by way of background, I'm 56 years old. I've been in fin services for about 35 years, dozen years on Wall Street. Really saw how the sausage was made in that factory, enjoyed it, learned a lot. But I ended up, which was pretty much a startup called National Financial Partners in the year 2000. Spent 15 years with them, saw it go from 80 million in revenue to about $1.5 billion. Watched them go public, exciting, keep growing. Did about 130, 140 deals with them. Watched them almost go bankrupt in the great financial crisis. Pretty scary stuff. And then watch them go private again. They went public and private at the same price, $23 a share, which was, probably close to a billion market capitalization, something like that. In 2015, I always loved dealing with the entrepreneurs. I was not the greatest corporate person, and we were fiercely competing against what is this whole new wave of the new private equity buyers in the last 10, 15 years. I was losing 1 out of 5 times. So for a guy like me that, gets paid for bringing in deals, I said, I'm better off, having 12 or 15 different buyers as opposed to just one. Yeah. So in 2015, established Authentic Advisors, still great friends with NFP. They're a class act, high quality firm, good client still, 2 deals with them. But there was a gent named Doug Waddington, spent 4 years with him at NFP. We were buddies, got along well, always kept in touch. And when I said to NFP, look, I really just want to do this on my own, I'll show you the deals, but they gave me their blessing. It worked out great. And Doug and I have, been pounding the pavement for the last 6 years.
Awesome. And so, what type of agencies are you looking for? What size? What was they, a mixture of everything, primarily personal, primarily commercial, good mix? What do you look for?
Look, we look for ethical, quality people. Okay. Again, it's a people business. If someone is a good person, we get a great vibe from them. You know what? If they have a $500,000 book of business and need help, we're going to help them out. The dozen deals that we did, say in the past year, I'm going to guess the average, commissions revenue is probably more like, 3 to 4 million. That's kind of usually our sweet spot. By and large, most of these firms have somewhere around a 30 to 35% EBITDA margin. So, you can do the math. We're typically, doing 12 to $15 million transactions. That's kind of our sweet spot. The funny thing is the 500,000 commission revenue firm is typically much more difficult to do a 10 million revenue firm, because the 10 million revenue firm has a CFO. They have everything in order. So it's a much higher level of sophistication, which honestly makes it much easier, for us to do all the, kind of due diligence, put together a memorandum on the business. And it really helps the buyers too, because, the better data that a sophisticated buyer has to share, or a seller has to share with the buyer, the easier our job is. But again, it comes down to, gut instinct and the way someone treats us, because, it's an incredibly important decision for these folks. They're typically probably going to do it once in their life. Some of the smarter guys might do it 2 or 3 times. But, we really want to be there to, make them feel excellent about their new partnership. And, it really hurts us to have a divorce rate, so we really try to get the cultural aspect correct as well.
One of the big advantages of using a firm like yours, instead of agency owners going out and doing it on their own, is, having all your ducks in a row, like you were saying, right? You got Doug, who's the CPA, who gets all the, finances sorted out and in order, gets the EBITDA lined up, which, by the way, let's go over, just in case we got people out there who don't know exactly what the EBITDA is that we've been talking about this whole time. Give us the bird's eye view of that.
Sure. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Yeah. It's simply, if you had a business that had 1 million of revenue, okay, and you strip out the true operating expenses of the business, that really would be mostly your staff, right? The compensation paid to employees, your rent, insurance, like real operating expenses. It's typically, probably 50 or 60% of the top line, right? Those expenses. So, the owner then takes his compensation, okay? And again, that compensation should be a fair market value salary, call it 150, 200 grand. So whatever is left over after all operating expenses and after the owner takes his comp, that's that EBITDA calculation. So by and large, someone with $1 million of revenue should have about 300 grand of EBITDA. Okay.
So when you're talking those multiples, so you're saying $1 million in revenue, 300,000 EBITDA, for example, you're saying, people are seeing upwards 9-10 times that EBITDA amount for the final sale price of their business, generally speaking.
Not really. I was saying if there's $1 million of EBITDA, they're at that 9 times.
Okay, so let's say 300,000. That's a whole different buyer then.
300,000. It's a little bit less. I mean, it's probably 7.5 times or 8 times. I mean, but who knows? Sometimes someone says, "Look, got to have it. They have this, little niche that I want. I'll pay 8.25, 8.5." It really depends on I guess the kind of the nature of the business and the setup.
Sure.
But I do want to address one thing.
Yeah.
I love dealing with the buyers who are kind of in that 250 million to 600 million range. They're a little bit hungrier. They're and plus the way the math works too. If you're going to take someone's stock, it's a heck of a lot easier to grow by 20% compounded annually. If you're at 500 million of revenue and your goal is to buy 100 million of revenue, that's 20% growth. But if you're at 2 billion of revenue and you only buy 100 million of revenue a year, that's 5% growth, right? So, we're trying to position ourselves with a high probability that the equity involved in what the seller is going to take, high probability that compounds out at a good 20, 25%. Now, not just for 3 or 4 years, but hopefully 8 or 10 years. Because these guys that get to 3, 4, 500 million of revenue, the odds are in 10 years, they're likely to get to $1.2 billion, $1.5 billion as well, right? And look, and then the guys that are at 2.5 billion of revenue, they're probably going to get to 3.5 billion of revenue in that same 5, 7, or 10 years. But where are you going to get your biggest bang for your buck? The guy going from 300 to 600,
So
So
those are the size buyers that you're dealing with. People with
that's who we love dealing with.
300
But
million to $650 million in premium volume, generally speaking.
happens to be our sweet spot. It doesn't mean if someone's a little bit larger and they have a relationship with one of the big guys, are included.
Right.
But if I looked at, where we went, in the last, year or two, that's the preponderance of who the buyers are that we're working with.
So Tom, tell me what are the advantages of, and feel free to insert your Authentic Advisor sales pitch here, because you guys did great for us and we appreciated having you. You brought us in front of a lot of buyers that otherwise, we never would have known existed, really. And they're big companies too, just weren't, in my operating radar. But what are the advantages of an agency owner coming to you, Authentic Advisors, or anybody really, any advisor, versus trying to go it alone?
Yeah, I think going it alone could be pretty tough. Number one, we're talking about, kind of EBITDA. And if you think about it, we're talking about 8 or 9 multiple points, every $10,000 or $15,000 change in EBITDA, that's $100,000 just about out of your pocket.
Yeah.
So that could almost, pay for this advice. So setting the EBITDA and knowing what to add back, because we know what the buyers are going to be adding back, because we were a buyer for 15 years. That's critical. That's real money right there.
Yeah.
Look, it's a little bit akin to, if you owned a couple $1 million house, you're not going to, for sale by owner. You're probably just not going to do that. So there are some, nuances in the EBITDA that I did describe. Look, the competition, really having 5 different parties at one time, with one source quarterbacking the whole thing and then making everyone compete. That it really drives up the multiple. Sure. So when you're trying to do this on your own, even if someone, says, you've never really thought about, hey, what is my business worth? And someone comes in and you get excited, and you could be leaving literally hundreds upon hundreds of thousands of dollars on the table, because, you really don't know what someone is willing to pay for it until you go through a process. And look, there's a half a dozen firms out there that do what I do. They're all good guys. I'm friendly competitors with all of them. And I never mind losing to anyone, because I feel good for the entrepreneur he's going to be served by having a professional relationship with an advisor.
Absolutely. And, that's the other thing about an advisor, right? Because you're representing the seller of the agency. And the more the agency gets sold for, the higher of a take that you guys make on it too. So it's like everybody's best interest to make sure we're dotting all our I's, crossing all our T's, and maximizing every dollar that we can find on the balance sheet.
Yeah, that's correct. Yeah. Yeah. And don't forget too, I've got to live with these buyers. I'm if I get 5 or 6 LOIs in on one deal, I'm disappointing, 5 other firms. So I also, want to keep feeding the buyers and showing them good deals. But no, you're right. Yeah, my compensation is strictly getting the best price for my client and ensuring that they have the best possibility for success in the future with that new buyer.
Absolutely. And I know we didn't pay you a dime until the deal was closed and the money was in the bank. So is that a typical way for advisors to structure their fees?
Doug and I are a little bit old school that way. We just, we want to put some sweat equity in. We want to make sure that there's a good fit. We don't need to, it's a small group of us, just a half a dozen. So I don't have big salaries I have to pay. So we don't charge retainers. I don't know if any other firm does not charge retainers, but we're comfortable doing business that way. And I think a lot of people like that.
We did. Yeah. So let's say that we've got somebody that has, maybe a $5 to $10 million revenue agency.
Sure.
And they're looking to start the process of growing, through mergers and acquisitions. We're going to have some folks on this episode that talk about financing those deals, because obviously financing is the biggest part of every deal. But I would say maybe even as big as the deal of financing is finding agencies to buy. I mean, how difficult is it right now for folks looking to start that acquisition strategy going into it?
Yeah, it's pretty darn difficult for the sheer reason that you let's call it you've got these 15 kind of massive buyers that have been out there now for 5, 7, 10 years, and they all own 200, 300 firms, right? So 300 times 10, and now you got 3,000 agencies that maybe are that 3, 4, 5 million revenue size. All of their buddies, like they're the guys that they play golf with that also own an agency, they're the biggest sales force right now for all the big buyers, is the firms that are already owned. And they've been through the process. It's like who is a better spokesperson to say, come with us? I've been with these guys for 5 years. It's terrific. So that's probably the biggest competition for guys like me. I mean, we're sending out thousands of emails a week, and the relationship that someone that's sold with someone that he's known competitively but friendly competitor, it's much easier for that guy to start a relationship than it is for me and authentic advisors. That being said, that fiercely independent guy who might be in his mid 40s or something like that's got 15 years of runway. I mean, he'll have a different story than becoming part of a national, player. So it takes hard work and dedication to finding it, and it takes obviously the financing part of it, but that cultural story, more of a familiarity with someone that he probably knows. Maybe the guy lives in the next town. The kids might have played sports. Those are typically the combinations that I think could work best. And maybe the seller, he's not looking to max out the selling price. He wants to be happy for 2, 3, or 4 years in his twilight of his career. So that 40-year-old guy trying to get together with a 60-year-old that has 800,000 in commissions, like that can happen. But there's risk involved. And it's timely, it's time consuming, and it costs money. So, and that guy with 5 or 7 million revenue, he really can't afford to make a mistake. But the guy with 400 million in revenue, if he makes a mistake or two at 1.5 million or 2 million in revenue, that it's going to dent his organic growth a little bit. It's not going to set him back, but the 45-year-old guy could get set back a little bit. So it's a different risk profile between that 45-year-old guy and the national.
Absolutely. So the buyers that you work with, I know some of them started off as agencies or agency owners themselves. What was their launching point into acquisitions? Do you know the story? Where did they go, you know what, we're going to turn to acquisitions and we're going to make it happen this way? How did they start doing that?
Yeah, there's trillions of dollars, out of 2 or 3 trillion most likely, sitting in private equity funds, and private equity guys can really get their arms around this recurring revenue stream. Technology so far, it started to change a little bit more, kind of year by year, some of the efficiencies, but by and large, property and casualty and health insurance, it really has kept that, kind of relationship business in place, a people business. So the guy that has that 5 million, if he wants to, try to do a more of a local type consolidation and get private equity money, probably going to be able to find it. So that's how almost all of them started. And some of them are just really good and aggressive and sort of get it and want to win. And look, if your private equity multiple when you recap is 15, 16, or 17, can you buy, at 8, 9, and 10 times kind of all day long? If, Yeah, you can. I mean, that's a good enough arbitrage right there.
Sure.
And it also lends itself to leverage, right? Your EBITDA, you can put 5 or 6 times debt on your EBITDA, because of the recurring nature of the revenues in this business.
Absolutely. So basically, what I'm hearing is that those guys that started off, just owning their own agencies and starting kind of the slow, acquisition process. Be really, really, really careful on those initial deals. I mean, you always got to be careful, right? But especially careful at the beginning because that's kind of the make or break period. And then, the bigger you get, maybe the easier it gets a little bit.
Yes, size typically begets size, pretty much across all industries,
Yeah, absolutely.
right?
Absolutely. Final words of advice for any agency owner that's looking to sell.
um, you know what? Just always do the right thing by your client, and you'll have a good business. Those are the best words of advice I can give to any business owner, not just guys in our industry.
Absolutely. Yeah, for sure. Tom, thank you so much for your time. Appreciate it a whole bunch and look forward to having you back at some point in the future.
I really enjoyed it, Abe. Thank you so much for having me.
Hey, thank you.